All right. So again, welcome to today's session. I want to tell you a little bit about this Lunch and Learn series that Kathleen and I are going to be leading. It's all about business fundamentals. And the goal here of this series is to provide you what we're calling bite-sized webinars with tips to manage your business and give you an opportunity to interact with each other. So we're going to have a portion of the session at the end here where we're going to open it up for questions and chance to share best practices if you'd like with your colleagues here. So we've got the schedule here. The first series is around knowing your numbers. These are financially driven topics. Today's session is understanding your financial statements. On Wednesday, we're going to be talking more in depth about cash flow. Next Monday, we're going to talk about budgeting tips. And then next Wednesday, we're going to go through risk management for small business owners. I'm going to tell you at the end about how you can register for those other sessions if you haven't done so yet. So more to come on that. We're going to do future Lunch and Learn series, the future modules. We're going to cover these topics you can see on the screen: operations, sales and marketing, and other tools for success. These topics, these sessions are all going to be individual sessions. We're telling people you don't necessarily have to attend all of them, but you will definitely learn a lot more if you do. So we recommend you join us for all of them if you can. And all of these will be held in the lunchtime hours of 12 to 1. All right, so let's jump right in. The topics we're going to cover today, again, all around your financial statements. I'm going to talk first about why it's important you manage your financials. It's sometimes not always the most fun thing to do when you're running a business. You all want to be out selling and marketing and helping your customers solve their problems, but it's really important to look at your numbers. We're going to go through the key financial statements. We're going to go deep on the income statement and the balance sheet today. We'll cover more on the cash flow statement on Wednesday. And then I'm going to walk you through some examples of how business transactions impact your financial statements. You're not going to get a full accounting lesson here today. We'll go a little bit deep, but not too deep. I don't want to scare you all off as a former accountant, but want to explain to you kind of how these simple business transactions impact your financials to really help make it real for you. And then we're going to have time for questions at the end. So I talked early on about why it's important to manage your financials. The first thing people usually think is, well, I need to understand my numbers so that I can give the information to my accountant at the end of the year to do my taxes. And yes, that's important. Record keeping for tax purposes is an important part of knowing your numbers, but it's not the only reason. If you have a good handle on your financial results, your income statement, your cash flow, and your balance sheet, it can really help you understand the trends in your business and in the market, what's happening with your revenue and your expenses and your profitability. Now, if you're looking back at your financial results, it's interesting because you can see where you've been. But I like to say that the past informs the future. If you look at back at your financial results and what you've seen over the last several months, or maybe the last year or two, it can really help you make better business decisions for the future. So that's going to help connect the thread when we get into budgeting next week about how you can take information from the past and use it to help inform the future and make better business decisions. Some of the key questions you can answer: can I make more money? Is my product or service priced right? And what might my business look like in 1 to 3 years? Looking at your numbers, getting a QuickBooks report is an interesting exercise, but it's not about just looking at the data and doing scorekeeping. You want to use that data to help drive better business decisions in the future. So let's jump right in. We're going to start with the income statement. Now, this is sometimes referred to as a profit and loss statement or a P&L for short, P&L short for profit and loss. If you hear any of these three terms, it's all the same thing. And what the income statement does is it measures profitability over a period of time. So I've underlined those words because it's important to recognize that when you look at an income statement, you look at it for either a month or maybe a quarter, which is 3 months, or a full year. So generally, if you run an income statement out of your QuickBooks report, you're going to say, what is my income statement for the month of April? Or the quarter ended March 31st, which would include January, February, and March. Or you might say, run my report for year-to-date April, which would include January through April. When you're looking at an income statement, you're never going to cross over from one year to the next. You wouldn't run an income statement that says, show me October 2022 through February of 2023. Businesses just don't look at it that way. when they get to the beginning of the new calendar year, they start over because you're looking over that period of time for the current fiscal year. These are the various terms you'll see in an income statement, and I've got an example on the next slide. Revenue and sales. These terms are used interchangeably. Sometimes you'll hear it referred to as what's my top line. This is money you're collecting for selling your product or service. You may hear the word profit. I'm going to get into that in a minute. You may also hear the term income. Income is another term for profit. Revenue and sales are the terms that I like to think about because this is your gross money that you're collecting before you account for any expenses. The next term you may hear is cost of goods sold, or COGS. It's sometimes shorthanded. This is the cost to acquire a product that you sell. This is really applicable in retail and manufacturing industries. So if you use an example, like if you're in the, you're manufacturing a part for a machine and it costs you $10 to make that product and you sell it for $15, the $15 is revenue because that's how much you sold it for. The $10 is your cost of goods sold because that's how much it cost you to produce that product. If you buy something and resell it, let's say you're in retail and you buy a shirt from an overseas manufacturer, they make it for you for $12 and you sell it for $20. The $20 is the sales price. The $12 is your cost of goods sold price. So this is important in retail and manufacturing. It's not really that applicable for service industries because they're selling their time. They're selling their service to generate revenue. Now, gross margin or gross profit is simply a formula of sales minus cost of goods sold. So in my earlier example of the shirt, if you're buying it for $20 or if you're buying it for $12 and you sell it for $20, that $8 difference is your gross profit, the 20 minus the 12. Again, that's not really applicable for service businesses because you don't really have a cost of goods sold. Operating expenses, sometimes called overhead. Operating expenses are the cost to run your business. So think your insurance. Maybe you pay your accountant. Maybe you have your utilities. Maybe you have rent if you have a physical location. It's also important to understand your operating expenses in terms of which ones are fixed versus variable. Fixed are costs that generally don't change over time with business volume. So if you sign a 3-year lease and your rent is the same each month of the year, that's a fixed cost. Regardless how many customers you serve, let's say you have a restaurant. If you have 0 customers or 100 customers a day, your rent is not going to change. That's a fixed cost. A variable cost is a cost that increases or decreases with your sales volume. So a variable cost might be, let's say you're a restaurant that is open more in the summertime than in the wintertime. If you're going to be open more in the summertime, you may have more staffing on hand because you need more people to serve your customers because your hours are greater. Your staffing cost would be a variable cost because it goes up as you're open more and you have more customers. Landscaping business is a good example of this, where your revenue may be really high in the summertime, so you have to increase your staffing. Or maybe some of your fuel costs are higher because you have to service more customers and you need to spend more money to service your mowers. So that would be an example of a variable cost. It's important to understand which costs in your business are variable versus fixed, because if you start to see some pressure on your business revenue, your fixed costs are not going away. Think about that restaurant. If you start to see a slowdown in your business, you think, well, maybe I don't need as many staff over the next few months because my business has been slowing down. You still need enough revenue to cover your fixed costs because that rent is not going anywhere because you signed that lease. So having a good understanding of your operating costs between fixed and variable is an important business fundamental. Pre-tax income, profit, these terms are used interchangeably. This is really sales minus cost of goods sold minus operating expenses. And you'll see an example of that on the next page. I use the word pre-tax because you'll want to look at your profit before you have to pay income taxes on it, because that's a general, your pre-tax income is going to drive how much your tax expense is going to be. But why don't we jump into a page, an example on the next page of what an income statement looks like. So here you can see laid out on the left-hand side, And this is just a sample with made up numbers. And this is a really kind of an example of a retailer or manufacturing company because it has cost of goods sold. So you can see over here, this business has sales of $1 million. That's the top line revenue they've sold to customers. They've got their cost of goods sold and then a gross profit of $650,000. So the gross profit will basically say, how much is my product generating in profit before I pay my expenses? So that's that $8 per unit example I gave with the t-shirt company. Then you've got your operating expenses. And then here, as I said earlier, you want to understand which are fixed and which are variable. So here you can see these are, a whole host of items. You've got marketing and staffing and supplies. They've got some travel and legal. Here's where you want to look at your expenses each month and say, all right, which ones what things can I do? Which ones are going to go up or down based on my business volume that I need to make sure I plan for? Are there ones that I can help drive to a lower cost to help save more money? But you want to also be careful and say, I want to be more efficient in how I spend money. But if I'm spending money on marketing and I have a marketing campaign that is really good, that's driving a lot of business to my restaurant or to my landscaping business, I want to be careful because if I cut that marketing spend, my expenses might go down, but my revenue might also go down. So as you're looking at your expenses and thinking about how to best manage them, ask yourself the question, which ones are generating revenue? If they're generating revenue like marketing, or they are needed to service your customers like staffing, you might want to be careful about reducing those because it could have an impact on your top line revenue. So we used to have a saying in the company I worked at, which was, you can't shrink your way to success. The best way to grow your profit is to grow your revenue. You can lower your expenses in the short term to help get through a rough patch, or maybe look for a better deal on your insurance or on your rent. But if you get too aggressive in cutting expenses that are going to impact either your revenue or your service experience for your customers, it could have a bigger impact that would be negative. So here you can see we have an operating profit line here. This is that profit line I explained before, which is your sales minus your cost of goods sold and your gross profit minus all these expenses gives you, this business is earning $273,000 of operating profit. And then they deduct interest expense. This would be the business has debt with a bank, so they're paying interest on that loan. And then they pay their taxes. And then their bottom line profit is $144,000. And this basically says, how much money did I make after paying taxes? So this is just a sample income statement. And I think I gave you a sense of the things to look for as you're looking through each line item every month. So now we're going to move on to the balance sheet. Now, the balance sheet is the second key financial statement that you're going to look at. And this tells the financial health of your business as of a point in time. So I've got these words underlined because this is a different measuring concept than the income statement. So earlier I said the income statement says this is activity over a period of time, January 1st through March 31st. What were the sales and profit for my 3 months? Think of the balance sheet as taking a snapshot picture as of a certain date. So when you run your balance sheet out of QuickBooks, it's going to say as of March 31st, 2023, or as of December 31st, 2022. If you enter more accounting transactions in your QuickBooks on April 1st, and then run a balance sheet on April 2nd, it's going to look different from March 31st because you're taking a new snapshot, a new picture as of that new point in time. It's just a different measuring concept. There are 3 components of a balance sheet, and I'm going to walk you through an example in a minute. The first is assets. And the components of a balance sheet that's in the name actually is that a balance sheet balances. And the formula is that assets equals liabilities plus owner's equity. It's the way the accounting rules are set up. You'll see that when we have a real balance sheet in a slide, in the next slide. So what are assets? Assets are what your business owns or what others owe your business. So what does that mean? Well, you can see examples here. Cash in your bank. You've got a business bank account. There's cash in it. That's an asset. If you've invested in certain mutual funds or CDs, that's an investment. That's an asset. Accounts receivable. So accounts receivable are where you sell something to a customer today and they agree to pay you in 2 months. As of today, they owe you money. You no longer have the item they sold you. That's an accounts receivable. That is an asset to you because you're going to turn that into cash in the next month or two. So that's an asset. Let's say you're a manufacturing or retail company. You have inventory on hand. You bought inventory last week. It's sitting in your business today. You've spent the cash. You have inventory. That's an asset for you today. The next item, property, machinery, and equipment. If you've got a restaurant or you've got a manufacturing facility, these are assets that you own. Again, your business owns those assets as of that point in time. You own them. They're on your balance sheet. Liabilities are the opposite of assets. They are what your business owes to other people as of that point in time. So let's take the opposite of the accounts receivable example. Let's say you bought inventory for your business today. You received the inventory, but you haven't paid your vendor yet because you don't have to pay them for another 2 months. You've got net payable terms that say you can pay them within 60 days of receipt. As of today, you've got that inventory. It's an asset to you, but you have a liability. You owe that vendor money. So as of today, your balance sheet is going to have a liability that says you're going to have to pay them in the next 3 months. Because when you run that balance sheet as of today, that snapshot point in time, you want to know, hey, this is great. I've got inventory on hand, but I want to also remember that I've got a liability I've got to pay in the next 2 months because I've got to make sure I've got cash on hand to pay that liability. Other liabilities. If you owe taxes to the IRS or the state and you haven't paid them yet, that's a liability. If you take out debt, that's a clear liability that a lot of businesses have. You got the cash for a loan and you have to pay it off over the next 3 years. That liability is going to be on your balance sheet the whole time. The last component of a balance sheet is called owner's equity. This is probably the hardest one for businesses to understand. And that's because it's a little bit accounting jargon, but I'm going to try to explain it in the easiest way possible. And I think this might become a little clearer when we go through our example of how transactions impact your financial statements. So if you think about the owner's equity as being the components of 3 transactions in the entire history of your business, from day one when you set up your business up through today's picture point in time, it's the sum of 3 things. It's the amount of money you've put into your business, any capital contributions, that's number 1. Number 2 are profits that you've made from day one up through today, minus any money you've taken out of the business through owner's draws. Take those 3 things, add them together. Money you've put in, plus profits, minus owner's withdrawals. That's your owner's equity. You'll see that in a minute when I go through how transactions impact your financial statements. Owner's equity is also called the book value of your company. Now, sometimes when people hear the terms book value, they think, oh, is this what my company's worth? Or if they run their balance sheet and they say, I'm thinking about selling my company, is this what my company is worth, this equity category? The answer is no. Book value and fair value are 2 different things in terms of accounting and business. Book value is an accounting term that represents just what I said. It's those 3 components of owner's equity. Fair value is something different. If you were looking to sell your business, fair value is not really an accounting term. It's more of a business finance term. And if someone were to say, I'm interested in buying this company, they're going to want to understand what the fair value of your company is. And they're going to look at the following things. They'll look at your balance sheet to see what you have for assets and liabilities, but they're going to want to look at the future potential of your company. So fair value takes into account things like, what's the future cash flow of this business over the next 3 to 5 years? What's the intangible value of the business's assets, their trademarks, their customers? How strong is their brand? What do I think the future value of this is going to be integrated with my business and what I think I can do with this business over time? And they will take all of those things into consideration along with your assets and liabilities, and they're going to come up with a fair value for your business and say, this is what we want to pay you for your business. Very different from an accounting answer. What we've been talking about is more accounting. So book value and fair value, very different things, very different analysis. It's an apples and oranges kind of thing. All right, let's look at an example balance sheet. So this is just a made up company. You can see at the top, it says as of December 31st, 2023, let's say. One thing you'll notice about a balance sheet is that more often than not, the assets will be listed on the left, the liabilities and equity will be listed on the right. So you remember I said that a balance sheet always balances. You can see here at the bottom, this business has total assets of $910,000, total liabilities and equity of $910,000. The liabilities are $450,000. The owner's equity is $460,000. When you add the two together, you get $910,000. So let's look at how a balance sheet is organized. All of the assets are on the left, and the assets and liabilities are generally listed from most liquid to least liquid. So what does that mean? Most liquid means something that you can quickly turn into cash. So the first item on a balance sheet is always the cash in your bank account because it's cash. It's the most liquid asset you have. Then as you move down the balance sheet here, you can see that they've got short-term investments next. Those can quickly be turned into cash because they're probably CDs or something that can easily be sold and generate cash. Then you have accounts receivable. You've already sold your product. You're going to collect cash from customers pretty quickly. That's going to turn into cash pretty soon. Inventory comes next. That's after accounts receivable because you haven't sold that inventory yet. You still need to sell it, then turn it into accounts receivable, then turn it into cash. Then you have prepaid insurance. This might be something where you decide to pay your insurance a year in advance because you get a better deal on it. That's a kind of a prepaid expense. Then the next thing, you've got long-term investments. So in this instance, they've made some investments that are going to mature over time, and they're not going to turn into cash pretty quickly. And then the other major item to point out here is property, plant, and equipment. And so in this instance, they've got land, they've purchased some buildings and equipment, and those have depreciated over time. We're not going to get into depreciation today. It's more of a longer topic. But the important point to take away with property, plant, and equipment is these are things that you've made a long-term investment in. You can't turn those quickly into cash because if you needed to sell your building, it's going to take you a long time to find a buyer, set a price, figure out terms, negotiate financing. It may take you a much longer time to turn that into cash compared to, say, collecting an accounts receivable from a customer. The last item on the balance sheet is goodwill. This is generally where a business buys another company and it creates goodwill from the balance sheet. It's called an intangible asset. Not going to get into that. It's more of a deeper accounting topic than today. But as you can see here, the important point about looking at a balance sheet when you try to assess your financial health is you want to ensure that you've got a lot of your assets in this current category, especially if you're thinking about working with a bank to get financing. A bank is going to look at your balance sheet in terms of your financial health and say, how liquid are they? Are they going to be able to pay their loan timely? I'm going to make a loan to them and I want to make sure they can make their debt payments. So it's important to look at your assets. If you've got a lot of your money tied up in long-term assets like a building and not a lot in current assets, it might indicate a potential liquidity problem where you might not be able to pay your bills. Quickly on the other side of the balance sheet, you can see the liabilities listed out in the same kind of thing. You've got accounts payable. Here's some other payables that they've got either to a bank for interest or to the government for taxes. Here they've got their loan obligations. They've got different loans they've taken out. And these are longer term liabilities because their loan payments are like a mortgage. They're going to be paid over many years, whereas your accounts payable and salaries are going to be paid quickly. Again, current liabilities meaning things you're going to pay soon, longer term meaning things you're going to pay over the next, 1 year or later. Down at the bottom, you've got stockholders' equity or shareholders' equity, capital stock. This is money you've put in minus money you've taken out. Retained earnings, that's your accumulated profit over time, all the money you've earned over time. So those three components of equity are captured in this bottom section here. So the next slide, I'm going to walk you through pretty quickly, and we're coming to the end of our prepared section here.
Hey, Steve.
Yeah, go ahead, Kathleen.
I have a couple of balance sheet questions, one of which you've answered on the screen, but I wanted to point it out, and which was, is a bank loan a liability? And it is showing on the screen as a liability, but I just wanted to make sure that everyone sees that. And the second one, is a deeper question about prepaid insurance, about how is that an asset and why isn't it an expense?
Good question. So the way prepaid insurance works is here's how the accounting for this works. When you have an insurance expense, the accounting rules say you're going to incur that expense in your income statement for the time period in which it relates to. So what does that mean? Well, you have an insurance coverage every month of the year. So if you pay $12,000 a year in insurance expense, you record $1,000 a month in your income statement of an expense. If you paid that $12,000 on January 1st, you didn't incur $12,000 of insurance expense in 1 month because you have insurance coverage for all 12 months. The accounting rules say just because you paid $12,000 in January, you don't expense it all through your income statement in January. You expense $1,000 per month through your income statement. So in January, you have $12,000 of what's called prepaid insurance expense. You've paid it all in cash, but you haven't incurred the expense yet because you haven't incurred that coverage yet. So in February, what you would do is, in January, you would incur $1,000 of insurance expense. And at the end of January, you'd have $11,000 on your balance sheet. In February, you would record another $1,000 of insurance expense. And at the end of February, you'd have $10,000. The end of March, it would go down to 9. At the end of April, it would go down to 8, and so on. So you get to the end of the year. So prepaid insurance basically means on a cash basis, you've paid it now, but on an income statement basis, you expense it over the life in which the expense relates to it. So I hope that makes sense. It's kind of an accounting specific question.
And does it depend on the dollar amount as to whether you do that or not? For example, if I have a software expense that I incur, say for my website hosting, that's $350 a year, do I have to do the same thing, or because it's under a certain threshold, can I just expense it when it happens?
You can do that. And a lot of companies will do that. They'll basically use a rule of materiality and say, if something is immaterial, I'm just going to expense it as incurred. Now, when it comes to preparing your taxes, so to answer your question, Kathleen, yes, you could say, I'm not going to bother amortizing $30 a month into my income statement and tracking this every month because it's so small. I'm just going to record it now. Now, for tax purposes, your taxes are really based on pretty much on a cash basis. So your accountant is going to say, I don't care if you pay the insurance in January or every single month of the year. If you paid it for the year, that's when we're going to claim it as a deduction on your income statement for your tax purposes. All right. So the next, everybody doing okay? All right, good. We still have the bulk of the crowd here, so that's good. Everybody's hanging in there. All right. So we're going to go a little deeper on the accounting here. So bear with me. I'm going to try to illustrate to you how these simple business transactions impact your financial statements. And I had this observation one time with a client where we were going through their income statement and we were kind of talking through everything. And they said, well, where's my owner's draw? How come that's not on my income statement? And I said, well, that doesn't go through your income statement. It's a balance sheet transaction. And then I had a light bulb go off and say, maybe we should talk about how all these one-on-one transactions impact your financial statement. So I'm going to give you some examples here. So what I've created here is a simple condensed income statement up at the top. Revenue, cost of goods sold, operating expenses, net profit. 3-line income statement, very simple. Then I've got a condensed balance sheet. You can see my assets, my liabilities, and my equity. And what I'm going to do is explain to you how when you do each one of these transactions, how they impact the financials, the income statement of the balance sheet, and how you're going to see each time the balance sheet remains in balance through every single transaction. So the first thing we do, we put $50,000 of cash into our business. Doesn't impact the income statement. All you've done is you've created equity in your balance sheet. You've added $50,000 to your business bank account, and you've added $50,000 of capital to your equity. Remember what I said equity was? Money you put in minus money you take out plus profit. Simple. First transaction. Second one, you decided to go out and buy some inventory from a vendor. You paid cash for it. You haven't sold anything yet. You just bought inventory. You went and sent a vendor $15,000 in cash. They sent you $15,000 a shirt. All you've done is traded one asset for another. Your assets have not changed in total value. Your cash has gone down, your inventory has gone up. No impact on anything else. Okay, next transaction, we sell some of that inventory. What did we do? We had $15,000 in inventory. We sold $12,000 of it for $20,000 in sales revenue. We made $8,000 in profit. That's an income statement transaction. What do we do? $20,000 in revenue hits that top line revenue, right? That's how much we're getting from our customer. $12,000 of cost of goods sold. That was the cost of the inventory that we sold. We made $8,000 in profit. That's how it impacts your income statement. How does it impact your balance sheet? Well, I sold it on credit. I don't have the cash yet. So I've created an accounts receivable asset of $20,000. But I sold $12,000 of inventory. So my inventory has gone down $12,000. My assets net increased by $8,000. What else changed? No change in my liabilities. My equity went up $8,000. Why? Net profit. So remember those three components of equity: money you put in, minus money you take out, plus your profit. That $8,000 profit in your net profit on your income statement goes into your equity. And you'll notice how this transaction, again, your balance sheet is balanced. Next one, you decide to collect some of the money from your customer. Your accounts receivable has now gone down $8,000. Your cash went up $8,000 because you got that money from the customer, put into the bank. Total assets haven't changed, but your cash has gone up. You've gotten more of those liquid assets that you like to see. Next transaction, you decide to pay some of your rent with cash. This is an operating expense. It's an operating expense, which means my profit has gone down $1,000 because I incurred an expense. My cash has also gone down $1,000. And my equity has gone down $1,000 because my profit went down $1,000. And again, balance sheet remains in balance with each transaction. Next, you decide to go purchase some equipment by financing it with debt. So you go out and decide, I need something for my business. I'm going to go buy $48,000 of equipment, and I'm going to take out a loan. So what happened here? Nothing happened on your income statement because you haven't sold anything. You haven't expensed anything. You just added an asset, but you also added a liability because you bought something with debt. So again, your balance sheet remains balanced here. Then you have to make a debt payment. So what happens here? Well, I have to make a debt payment of $3,300 to my bank. There's two components of that. I make a principal payment of $3,000. I make an interest expense payment of $300. This gets a little confusing, and this becomes a question sometimes with my clients where they say, where are my debt payments on my income statement? Well, when you're paying principal, you're reducing the liability on your balance sheet. So in this example, my $3,000 in principal, my debt goes down from $48,000 down $3,000. I paid cash of $3,300. That $300 of interest is an expense. That's an expense that impacts my income statement. My profit goes down $300. And you can see on my liabilities and equities side, my liabilities changed $3,000. My net profit went down $300. Again, the balance sheet remains in balance for each transaction. That one's a little trickier, not as straightforward. It impacts both your balance sheet and your income statement at the same time. Last transaction we're going to cover here, an owner's withdrawal. You're basically taking equity out of your business and you're taking cash out of your business. So you can see the cash goes down. My owner's equity goes down because remember those three components of owner's equity. And again, each transaction's an equal. So if you add everything up across, you'll see all of the impacts of the transaction. Every single transaction that impacts the income statement and balance sheet, your balance sheet remains in balance the entire time. And at the beginning of the time period for this business, they had $50,000 in cash, $50,000 in equity. They had all these transactions occur, and you can see at the end, what did they have? They had a $6,700 profit. They have $33,000 in cash left. They still have $12,000 in receivables. They still have $3,000 of inventory. They have $48,000 of equipment. They have $45,000 of debt because they started with 48, but they paid down 3,000. And then in their equity account, they have $45,000 of their capital account because they put in 50, but they took out 5. So the 50 minus 5 is the 45. And then they have a net profit component of their equity of $6,700 which is the same 6,700 that's up here, for a total equity of 51,700. Total equity of 51,700, total liabilities of 45,000, total of 96,700, same total assets, 96,700. So you'll often hear sometimes debits and credits when you're thinking about accounting or your bank statement. The debits and credits always equal each other. This demonstrates that. I thought it would be helpful to demonstrate for everybody how certain transactions can impact either your income statement and your balance sheet at the same time, or just the balance sheet, because it's not always clear cut. Now, this doesn't make you a certified accountant, but it gives you enough of the tools to help understand some of the transactions and how they would impact your business. And there's a lot more examples we could go through. This was all I could fit on one page in one today's webinar, but I wanted to cover some of the ones that I think are more common for business owners. Kathleen, any questions that have come up that we should cover before we move on?
Nope, we're good so far.
Okay. All right. So we're coming to the end of kind of the prepared section here, and then we're going to open it up for questions. And again, we're trying to keep this bite-sized, not go too deep in every session because we got multiple parts. The third statement is called the cash flow statement. And we're going to go deeper on this on Wednesday. But a cash flow statement is similar, very similar to an income statement in that it measures activity over a period of time. So remember, income statement is a month or a quarter or a year. Balance sheet is snapshot as of a point in time. Cash flow is like the income statement. You say, what's my cash flow for the month ended March 31st? Or for the year to date, June 30th, which would give you January through June. You never say, what's my cash flow as of March 31st? You would say, what's the month ended or the quarter ended? Cash flow is easier to understand than an income statement. It's very intuitive. It's basically money going in and money going out of the business. Sometimes you'll hear the expression cash is king, and that's because businesses really need to focus on managing their cash flow. It's very simple math. Cash flow is positive when money coming in exceeds money going out. And it's negative when money going out exceeds cash flow coming in. You obviously want to be in the first section, not the second section. There's three components of cash flows. There's operating, there's investing, and financing. We're going to go deeper on this in session 2. The other thing we're going to do in session 2 is we're going to cover how an income statement and a cash flow statement are different. And it really comes down to things like receivables and payables and your debt. So if you go back to this example here, if you think about why cash is king, you sold this money here, you sold this product here for this client, $20,000 of revenue, but you haven't collected all the cash yet because you've created a receivable. You don't have that cash yet. You need to turn that receivable into cash quickly. That's why they say cash is king. The other component that's the difference between the income statement and the cash flow statement are things like investing in financing activities. Thinking about like when you finance like an equipment purchase, or when you take out debt, or when you pay down debt, or you put money into the business or take money out of the business. These are transactions that can significantly impact your cash line and impact your cash flow, but they may not impact your income statement. So what I like to say to people about the different financial statements is someone will say like, well, what's the most important one? And I tell them, well, they're all really important. They tell you 3 different things. An income statement says, how much money are you making? What's your profit? Based on the accounting rules, what's your profit? Revenue, expenses, and profit. A cash flow statement tells you, how effectively are you managing your cash? Are you turning receivables into cash? Are you taking out a lot of debt just to stay in business? Are you able to take money out of your business because you're making enough cash flow to withdraw money for your owner's withdrawal? And a balance sheet gives you that snapshot point in time, that financial health of the business. You know, if you're looking at a balance sheet and you say to yourself, you know, you'll hear the term overly leveraged, or, you know, do they have a lot of debt? You know, this is an example of a balance sheet where a business is in good shape. They've got a really good current assets and they don't have a lot of current liabilities. If this were turned upside down and a bank were saying, wow, this business has $150,000 of current assets and $450,000 of current debt, they would say, how are they going to be able to pay the debt that they owe of $450,000 in the next year if they don't have a lot of assets? They don't have a lot of money coming in. How are they going to make their debt payments? So the balance sheet gives you that financial health, that snapshot as of that point in time. So let's see here. I think that's the end of our technical topics on the balance sheet and the income statement. And we'll cover cash flow in more detail on Wednesday. I want to cover a few things before we're going to stop recording in a minute to let people chime in with questions. But before we stop recording, I want to tell folks who are here today and anybody who might be watching this later on YouTube about future sessions. So this is session 1 of our module on Know Your Numbers. We've got 3 other sessions scheduled this Wednesday, next Monday, and next Wednesday. They're all at 12 o'clock. They're all going to run about an hour or so. And here are the topics you can see that we're going to be covering. They're all somewhat connected. So we encourage everybody to join all of them. You can sign up for them at score.org. Go to Greater Hartford local workshops, very easy to find. We'll also send you a link tomorrow that you can register for the other sessions if you haven't been there yet. We also want to tell you about our YouTube channel. We have recordings of all webinars we've done in the past. This one will be up there for you to revisit. You can go to YouTube, search for SCORE Greater Hartford. You'll see all the webinars and playlists organized by business topic that you can check out. Be sure to subscribe. You can be notified of new videos. And then lastly, as Kathleen mentioned, we have a whole host of services that we offer at SCORE, including mentoring services. You can sign up for mentoring services at score.org and check us out that way. Kathleen, anything else I've forgotten before we end the prepared portion and move on to questions?
One question that I think might be worth to have in the recording, which is there a software that we recommend for startup companies to have control of their transactions?
Great question. I'll be frank. I'm not a software expert on this. I would say a lot of my clients use QuickBooks. I would say the most important thing, if you're just starting out, keep track of everything. Even if you're just using Excel, if you only have a handful of transactions per month, just keep track of everything. But that's just really important for record keeping purposes. It just makes your life a whole lot easier for not only your tax purposes, but just understanding how you're spending money and where you're making money. I would encourage people to use QuickBooks. I know it's a cost. Think of it as an investment in your business. It's pretty user-friendly. They have a pretty good help support system. And there's a lot of YouTube videos and webinars online where you can learn how to use it. I've got a lot of clients who use it who are not accounting experts, but they can figure out enough to be able to manage their own books. You can also talk to an accounting firm who offers bookkeeping services. If you have a lot of transactions and just don't want to spend your time entering transactions into QuickBooks every day, you can have a bookkeeper work with you who can help, set up processes for that.
And I would say a startup company could be anything from a solopreneur with a tiny little side business to a startup company that's looking for financing and wants to do an IPO at the end of it. And so if you're the former, you definitely can start with something simple like Google Sheets or Excel or whatever the Apple equivalent is. And then as you grow, convert everything over. If you want to be a startup company that you want to turn around and make it public or sell to investors over time or get big financing from investors, you're going to need to be as professional as possible right out of the gate.
Couldn't agree more. Absolutely. All right. So with that, we are I'm going to stop the recording in a minute. Those watching on YouTube, thanks for joining us, and be sure to check out our other videos, and we'll stop the recording here.